Today I'm starting a new series, which is I'm starting to present excerpts from my memoirs in this podcast series. And the reason I'm doing this is because now my memoirs are at the point where we talk about the times when Orange Capital Partners started. So this is now the previous 15 years of my life, and it's going to be probably the last third of the book. Hopefully I'll see how that works out, but it's a work in progress. But what I'm doing here is now going through the times that me and Zovinar went through when we founded and launched and then continued working with Orange Capital Partner ever since the launch in March 2008 until today. And hopefully I can give readers a good sense for that process. The goal of the book is other than just giving a memoir of my life and trying to capture the emotional part of my life. It is also hopefully going to be an investment book through the lens of a narrative of a person, and not through the lens of some finance gibberish. So that's the goal of the book. And the goal of this podcast series, of course, is to give people a sense for what it feels like to run a hedge fund. So what we're doing here now is going through excerpts. I'm going to pick them as I choose, as I feel. In this particular case, I'm talking about the first investment idea that made money, and I'm going to go through the emotional aspect of it, because I think that's really the key here. A lot of investing, as I'm going to elaborate a little bit more, is about closing the semantic gap between what you think you see and what is actually going on in the business world. There's a big semantic gap. I mean, we all have it. Humans have it. It's a concept I borrowed from computer science. I'm going to elaborate more deeply, and I'm going to also talk about the inverse of the semantic gap, a situation that we encountered that we thought was a very bad situation, turned out to be a pretty good situation. So the semantic gap goes both ways in investing. This is the Not Even Wrong podcast. It's February 23rd, 2023. This is Krim Delko. Since the last update, we're up 2.2%. The market is down 40 basis points. For the year, we are up 63.6%. The market is up 3.9%. We're outperforming by 59.7%. So in this particular episode, I'm talking about a section in the book. I'm going to use an excerpt of the book where I talk about the first investment idea that made money. And what happened is the following. So we launched Orange Capital Partners in the March of 2008. And like everybody else, we had some launch difficulties, raising money and all of that kind of stuff. But towards the summer of 2008, we kind of had our stuff together. We had some capital raised, and we were ready to launch. And then we decided to do a trip to Scandinavia. And I'm trying to elaborate in the book how important that is to really go and try to look where nobody else is looking. So we're talking summer 2008. The market is, let's say, a little bit nervous. The market's occupied with Bear Stearns, with Lehman Brothers, with Wall Street, all of that kind of stuff. So now we're going to Scandinavia. Why on earth would we go to Scandinavia? And I think I'm trying to emphasize here that it's really, really important to look where nobody else is looking when you look for investment ideas. Investment ideas are very rare. They don't come that often. Investment ideas are like inspirations in art, like great music, great ballet shows, great movies. They just don't come that often. And you have to go and look and turn a lot of stones. And we chose to go to Scandinavia, not necessarily because we were so interested in Scandinavia. Yes, we were interested. There were some interesting things, and I'm going to get to the point. But it's more important that you go somewhere and you try to really understand how the people feel there. What are they thinking? How do they look at the world? And it's really, really useful to do that sometimes outside of your used environment. So the environment that you use, if you go and talk to other people on Wall Street about what's going on in the financial markets, you will very often have the firehouse effect. I'm saying most of the time. Sometimes it is actually useful. And I'm going to get to that point maybe later when I talk about the 2008 financial crisis. Well, that was happening on Wall Street, and it was pretty useful to actually talk to people who were in the thick of things. But back then, it's summer 2008, so we're not there yet. And the point here is I'm going to get to the conclusion and then elaborate. What we've learned on that trip is that oil prices are way too high and they make no sense. Now, you might think in hindsight, well, at $150 a barrel, of course, oil prices were too high. What were you? You had to go to Norway to figure that out? Well, look, it's not that simple, right? It's easy in hindsight to say, well, this was too high and that was too high. But when you're in the thick of things, in real time, as an investor, putting real money at risk, it's not so easy. And the reason it's not so easy because you have to close the semantic gap. You might feel that something's wrong, but you don't see what's going on under the hood. You don't see what's really going on, and you might be wrong. You might, China might have decided to buy oil up to $500 a barrel or something. Who knows? In hindsight, yes, it turns out that the Wall Street shenanigans of 2000, working up all the way to the financial crisis, plus China recklessly buying commodities in the wake of the 2008 Olympics in Beijing, that drove up commodity prices. We also, of course, couldn't know that when we were in Norway, at that time, actually, we had a meeting with the CFO of Yara. That day was the peak of oil price. And that was the day that we realized that we have to short oil. We didn't know all that stuff. Why did we realize to short oil in 2008? Because we had a meeting with a very highly educated, very professional CFO, and he made no sense to us. The whole country of Norway made no sense to us. Everything was expensive. People treated working for money like it's some sort of esoteric hobby. They were basically like a trust fund, a social trust fund where everybody just sort of has fun, all of that kind of stuff. They're nice people, don't get me wrong. I'm not trying to bounce off Norway here or anything. To me, Norway was kind of that little scar that you see on a body that is metastasized by cancer. And the metastasizing of cancer, of course, in this analogy, is the global financial markets, which were completely out of whack. And the commodities were sort of the peak of the iceberg. There's a lot more to come. The 2008 financial crisis was obviously much bigger than just the commodity crisis. In fact, commodities recovered first, but that's another story. My point here is the following, and this is what's important. Okay, you're a trader, you're going to Norway, summer 2008, you're interviewing people, you're meeting with people, we're looking at oil companies, we're looking at drilling companies and rigs and blah, blah, blah. But the point is, the country doesn't make sense. It feels like a benign version of the Gulag Archipelago, where you know that I lie, that he lies, that we know that you lie. Like, it's that kind of thing. Everybody's not telling us the truth. Nothing makes sense. Like I said, people literally treat work like it's some sort of esoteric hobby. The people we talk to on the Wall Street guys there, meaning the bankers and the traders, they all like have this nihilism in a sense, like, what's this? Why do you even have to make money? What's the point? Like, it's some sort of utopia, some sort of socialist utopia underpinned by oil money. Look, all of that stuff is fine. These things can happen, right? It doesn't mean you go and short oil just because you step foot in Oslo and things are expensive. But when things get together, when you start connecting the dots, and then somehow it just clicks. And that's when that semantic gap closes, when what you think you see is very close to what's actually going on, which in that case was just the absurdity of high oil prices. So we put on an oil short, which made our year in 2008. That was our first year. We were up 28% after fees in a year, of course, when everything was down 50%, which helped the fund a lot. That's, of course, goes without saying that if you can outperform a bad market like that, you will have a much easier time raising money going forward. The other semantic gap I want to talk about is the exact opposite. So on that same trip, we met the CFO of Carlsberg. And Carlsberg, again, I'm going to give you the conclusion and then elaborate. The conclusion was that Carlsberg was a really bad company back then. You would never have invested in that company. And it turns out it was actually a pretty good investment. And if you took 100 people from the top 3 finance business schools in the US, Chicago, Wharton, and MIT, and you put them, you give them 2 case studies in the summer of 2008. One is Yara, which is a fertilizer company, and one is Carlsberg. I would guess 99% if they just regurgitate what they learn in business school, they would tell you buy Yara and short Carlsberg. Turns out that Yara did nothing over that period of time. It collapsed from about 450 kroners down to 100, and now it's back to about 480. So now it's starting to outperform a price that it had 15 years ago. Now there's some dividend here and stuff, so it probably did better, but you get my point. Versus Carlsberg has doubled, and they also had dividends. So it's we're comparing apples to apples here. My point here is that, look, you're looking at the company of Carlsberg, right? They just had bought a very large Russian company, a beer company. They had lots of debt. And we're talking summer 2008. I'm not even anticipating a collapse of the debt market, yields going through the roof, meaning corporate yields, and then the Russian invasion of Ukraine and all of these things. But knowing that you're deploying lots of capital in Russia, you can kind of anticipate all these things. You know that that's going to happen. Sooner or later, Russia will screw you. That's what Russia does. That's why the returns investing in a country like Russia are so high. Because for sure you're going to get screwed. The question is how much and how are you going to get out of it? And the point here I'm trying to make is there is a big semantic gap also here, in the sense that you might think that logically, whatever you see, whatever you know from that company, from Carlsberg in this particular example, you just don't want to buy the stock because, again, high debt, Russia is risky. There's not a lot of, how are you ever going to make money? On top of that, there was already a feeling in the Russian market that the government wants to backlash on alcohol consumption, which is not good for a beer company. So everything is going wrong. Now, the company still did very well. Why? Because the actual business on the ground, Carlsberg is a fantastic company at creating near monopolies for themselves. That's what beer companies do, the good ones. And particularly in emerging markets or markets like Russia, where the antitrust and all that is not very, it's basically a matter of how much you pay people so they leave you alone. My point here is this goes back to P the theory, very important. It's P times Q, okay? The size of the market times Q, which is your share of that market. That's what decides wealth. It's not the size of the market. Lots of companies, and that's a big mistake in Silicon Valley, they talk about trillion-dollar markets, but what's your share of that trillion-dollar market? If your share is tiny, I don't care how big your market is. What I want is monopolies. Now, I don't want illegal monopolies, of course, as an investor. I want the kinds of monopolies, the Darwin-type monopolies, where you evolve into your own niche and create your own market, or at least you create a market maybe that's already existing, but you change the dynamics by lowering the cost by iteration and all that. We spoke about this in the past. Now, in the case of Carlsberg, I would say there's probably, the truth is somewhere in between legal and illegal. I'm pretty sure not everything is kosher what they do, but that doesn't matter. It's a publicly listed company on the Copenhagen Stock Exchange, and I'm okay with whatever they get away with. And doing business in places like Russia and Africa and even China, I am sure it's not, at least in the beer business, things can get, bumpy. Let's leave it at that. But here's the point, what I want to take away in this particular episode, which is there's this semantic gap that in both cases, with Yara and with Carlsberg, back in the summer of 2008, there was this big semantic gap. And as an investor, you have to be very, very careful. Yara was on the brink of explosion, meaning in a good way, because, well, there was this unlimited food demand from China, and Yara is a global leader in fertilizer, so they're going to do extremely well. Buy the stock. And Carlsberg is just bought a large chunk of a beer, bought a big beer company in Russia, issued a large chunk of that, probably 30-40% of their equity was now in debt because of this. Russia is a bad market, risky. There's a backlash against alcohol, short the stock. Well, that's what the logic would tell you, and the reality is often very different. And it's the job of an investor. That's what investors do, to close that semantic gap. So to summarize, this is the first excerpt from my memoir about my life, and this is now the section, the last third of the book where I talk about Orange Capital Partners, and therefore I'm going to start now introducing excerpts from the book, and this is the first excerpt where I talk about the semantic gap concept, and I introduce it through two case studies that we actually encountered with traveling, back then to Scandinavia, in particular Norway and Denmark, and we met companies. One is Yara and one is Carlsberg, and I'm using those examples to illustrate the semantic gap, that how sometimes you might think something's good and it's not that good, and vice versa. Thank you.